for joining me today on this topic of debt to income ratio, which is in the series of demystifying the mortgage process for buying a house. Uh, I'm going to be using the ratio that FHA is using right now at the time of this recording, which is 29% over 41%. The 29% represents front end and the 41% represents back end. And let me break it down for each section. The 29% is your total mortgage expenses for the month. For example, the principal and interest, homeowners insurance, property tax, homeowners association fees if they apply, and private mortgage insurance if they apply. All that added up cannot exceed 29% of your gross monthly income. Let's see, and the back end, which is 41%, is basically the front end plus your monthly reoccurring debts, such as credit card, car note, student loan, whatever your monthly reoccurring debts that are showing on your credit report. So to give you a more of an example, I'm going to give some numbers. I hope I don't lose you with the numbers. Let's say your gross yearly income is $40,000. You take that $40,000 divided by 12 months, gives you $3,333 per month. So that's your gross monthly income. So you take you multiply 29% times $3,333. You should get $966. That's the max allowed for your gross monthly income that FHA will allow for the front end. Now for the back end, you add let's say you have a car note for $240. You have $260 minimum payments per month for credit cards, which equals $120, and you have student loan for $40 a month. If you add that $240 plus $120 plus $40, it should give you $400. So let's add $400 to $966, and that should give you $1,366. That is the max allowed on the back end. So to be clear, a lot of questions that people used to ask me, well, let's say you have a credit card limit of $5,000 and you've used $2,000 of that limit. The lenders only look at what that credit card company is reporting as the minimum monthly payment due. And for this example, I said it's $60 a month. So don't get worried about your limit in that regard of how they calculate it. And let's say you have a student loan that is deferred. Remember, in some instances, it's at the lender's discretion. They may require you to contact your lender to find out what is the minimum monthly payment of this student loan when it's no longer deferred. So keep in mind, you may have to contact him to do that. So what I just described to you was debt to income ratio. I gave the front end, which is 29% of your gross monthly income. It cannot exceed that. The back end is 41% of your gross monthly income. It cannot exceed that. Back end is basically your front end amount plus your monthly reoccurring debts. So this concludes this topic of debt to income ratio. Please check out other topics in our series of demystifying the mortgage process for buying a house. Thank you for watching. Spread the word. Don't keep me a secret.